Hey guys, welcome. Today we are going to look at two very important topics. Of course, risk and uncertainty, very different, and we're going to actually show you that today. Most people do think of risk and uncertainty as pretty much the same thing when it comes to the markets, but we're going to show you exactly why that isn't the case. So of course, just for this introduction here, the whole purpose of this presentation is to be looking at, of course, what we want to gain from this and this lesson in particular. But since risk is really the only thing we do have control of in the market, it probably deserves to have a closer look. And hopefully by the time we're done here, you'll realize how probability and thus a higher understanding of the market can actually obtain order of chaos. So what's our agenda look like? And we're going to be, first of all, wrapping our heads around uncertainty, right? We're going to be looking at and dealing with uncertainty as well as situations of uncertainty. And finally, after we go through all those scenarios and whatnot, you'll begin to develop that understanding. Uncertainty isn't something that you'll be afraid of, but something that you'll welcome. And using gaming theory, of course, to increase return and to reduce your risks. So uncertainty sucks, okay? And we all know that, and we know that because, relationships might feel uncertain, your health or your job. And a lot of time goes into uncertainty, right? We worry about uncertainty. We plan for uncertainty so we're not sort of caught off guard or blindsided is another sort of term that people use. And Dennis, he's a motivational speaker, but he says, expect the best, plan for the worst, and be prepared to be surprised. And obviously, when you trade the Forex, you can't really be a motivational speaker, so we're going to turn that around to something more applicable and say expect the worst, plan for the worst, and be prepared to be surprised. So that's kind of my way of saying that. So let's now move into how do we deal with uncertainty, because we all know that we spend too much time worrying about it, and that might translate into too much screen time when you're trading. But how do you deal with uncertainty? And what people do these days is they try to predict the future, and they do that by horoscopes. And last year alone, people spent $440 million on trying to see the future on things like psychics or card readings, crystal ball readings, just to help them deal with uncertainty. So this next slide obviously labeled oops for a good reason, because what's the problem? Well, risk and uncertainty are obviously mistaken as the same thing, right? People tend to link probability with losing money or a trade, but uncertainty is a little different, right? Uncertainty is just that, it's the unknown. An example of this would be, and I'll give you a real life example just so it clicks, but it's a hot, sunny afternoon, and you go inside the house, you grab some lemonade, you go to your basement to cool down, and you're sitting there with your glass of lemonade, just waiting for your body temperature to head back to some normal temperature here, and you won't start feeling so hot. And another scenario where we involve uncertainty would be, it might be 3 o'clock in the morning, it's raining outside, it's thundering and lightning, and you're hungry, so you go down to the fridge for a late night snack, and you take that piece of cake or whatever you grab, you go down to your basement, you turn off the lights, and you sit there with all that lightning going on. And you'll definitely feel that sense of uncertainty, even though you know what's in your house and you know where everything is. Just having the lights off provides you with that uncertainty. So what's the problem is that successful traders can face uncertainty, as we say, with the lights off, where an unsuccessful trader faces uncertainty with the lights on approach. They predict to the point where they believe they know what is going to happen next. Okay, and that's exactly, you can't try to predict the future. You can forecast it, you can guess, but ultimately you want to look at protecting your risk and stop feeling that uncertainty is a bad thing, because I'm going to show you how you can turn that around as just something positive. So how do humans view uncertainty? Okay, so in the middle we have uncertainty with a human, and they have perceived risk on one end, you have anxiety on another, and you have them realizing or having to realize that they won't have perfect knowledge with uncertainty. They won't be able to see exactly everything around them. That's fine. So we have this tug of war between two needs. We have this perfect knowledge that comes with knowing the future or what's around us, right? Dealing with that uncertainty. Or we have the hope for order, which, is if we have uncertainty. So we try to guess how things will turn out in life without even knowing what will become of it. And, without any source of uncertainty in our lives, we definitely begin to be less unmotivated, less wanting to do things. Like you just sit on the couch all day if you knew exactly what was going to happen to you in your life. So having some uncertainty there can be very good, because it gets you going, it gets you doing things. So let's tie this all in. Uncertainty we face in the dark has no real risk. It's just perceived risk, because we do not know for sure what is out there. So people desire an order or some sort of perfect knowledge that comes only when, as we say, turning on the lights. The market is a social system, okay? It has to give investors a venue for trading. Investors want to make money, but the market as an entity in itself, it doesn't really have that same goal, right? The markets are there to provide, plain and simple, liquidity. So really, the market's interest is to just make itself as complex as possible. The end result of making a system like the market, I guess you could say complex, is what we have, which is a rise and fall of prices and ultimately the transfer of wealth. So why does it exist this way? Well, the market offers everyone an equal playing field, right? And you have no advantage over me. If it was predictable, where we had that perfect knowledge, or we were trading with the lights on, then someone would have figured it all out and accumulated all the world's wealth, and the market would eventually die. But on the other hand, if the market was completely unpredictable, no one would have any real reason to participate. So again, there really wouldn't be a market. So, where do harmonics fit in? Well, we'll get into that, but it's an opportunity for everyone, but really no advantage to anyone. So harmonics, like many other nonlinear approaches, will work some of the time in the market, right? It needs uncertainty if it's going to offer opportunity to any investors. So harmonics will not work all the time, and that might be hard for people to handle. But it's true, and people need to realize that they can't expect it to work all the time, and you might have a few days of bad trades. You might have a stretch of, 15 bad trades, like once a year, or once every 6 months, or hell, it could be your first month while you're trying to trade harmonics. It doesn't really matter, but the whole point is we need to realize that they're not going to work all the time, but just like a casino, they have to dish out money to the people that come in, or else no one's going to come back. So think of it that way. And we're going to start diving into uncertainty now, and different situations. But there are times, guys, where we need uncertainty and times when we don't, right? But facing our own fears of the unknown is the only way as traders to develop, okay? Otherwise, if we don't, we're just going to basically do nothing with our lives, and you won't get anywhere in this game at all. So how do we tell, right? How do we tell when we need uncertainty and when we don't? And when should we be trading with uncertainty, right? Well, let's talk about this for a second. Let's talk about conspiracies. Humans use conspiracies to explain things they can't really understand, right? Like, we hate the idea that we could be these random victims and that, you know, nothing could have been done about the JFK assassination. You could also blame your brokers for your losses. There's tons of conspiracies out there in the Forex world. The stock market, the futures market, doesn't really matter. But come on, guys, get real. We are traders. We have to expect to lose. You have to welcome losing because you're not going to win every time. A lot of you, this might be hard to hear, but soon you'll see why in that clear vision of why you can't win all the time. But the definition of uncertainty says nothing about a chance of a loss. Okay, so don't get the two confused between risk and uncertainty. In fact, risk is something that can be quantified, right? But uncertainty can't because there is no loss associated to it. So let me show you now why you need uncertainty in order to lower your risk. Okay, so to prove this better, I'm going to give you some hypothetical situations that we can walk through and you'll clearly see what I'm talking about. The first one here is, we'll call it uncertainty situation number one, but you're standing at a long green table in a casino. You're balancing a pair of dice between your hands, bouncing them around, and around you is this crowd cheering you on. So you just won 3 rolls in a row. Okay, you throw the dice, they turn up 3 and a 2. So you have 5. Now you have to throw another 5, and if you do, you get 10,000 bucks. If you throw a 7, you automatically lose. So what are your chances of actually rolling a 5? So something like this sort of situation, all odds are really known in this game. Okay, winning is pure chance, and the kill comes in playing the odds, right? So knowing when to bet heavy and knowing when to minimize your losses by betting little, right? You can kind of relate that on how you might want to play harmonics based on time frames, which ones you might want to play heavier, which ones you might not. So the probability of throwing a 5 is 4 throws out of 36 if you looked at all the different combinations, or about 11%. So if we throw the dice 1,000 times, we should get about 110 5s. So here's situation number 2. This is going to get a little more complex. You're on a game show, we'll call it The Price is Right, and beside you is Bob Barker. You have just won, let's just say, a new piano. Bob's asking you to trade in your piano for whatever is behind one of the 3 doors. He tells you that behind one of the doors is a brand new Porsche 911 Turbo worth over $150,000. You choose door number 2 because you had 2 slices of bacon for breakfast this morning. The game show host Bob here, shows you what's behind door number 1, and it happened to have a trip to Fuji. So he asks you whether or not you want to switch to curtain number 3 or keep curtain number 2. And of course, 2 is the one that you had picked. So what do? This dilemma in the situation you might have heard of before. It's called the Monty Hall dilemma. And this dilemma has had a great deal of debate surrounded by it in different statistical groups, different groups of people debating this. And instead of explaining all about it and going through the logic, I'll just tell you what the whole conclusion is. But when door number 1 or curtain number 1 is eliminated, its 1 in 3 probability is now transferred to curtain number 3. Okay, so curtain number 3 now has a 2 in 3 probability of hiding the Porsche. So the reasoning, and basically in all these studies, mathematicians has, I guess, gone on from this, it's held up that at least the winds of about 2/3 of the time when you shift doors. Okay, so again, a lot more uncertainty involved here. So let's look at another situation of uncertainty, and this one's going to get more into what we do with Forex. So let's just say you're the chief economist at a large investment bank, we'll call it Harmonic Nation Group. The company invests billions of dollars into the bond market. Your job is to judge the direction of interest rates as its chief economist. So you're holding a press conference, a reporter from the New York Times asks you, what the odds are of the Fed raising interest rates. And you know that the Fed's primary goal is to control inflation while promoting some sort of economic growth. But if the economy grows too fast, prices begin to rise, and then if prices begin to rise too quick, it's hard to stop, inflation takes over, and without having any sort of a recession or throwing people out of work, you kind of note with the economy expanding and unemployment at 4.5% or 5%, whatever it's at, inflationary pressures may begin to build, but nothing has really begun yet. So you say yes to the reporter, and he says, so what are the chances of the Fed's raising interest rates? And how do you respond to something like that? Well, since this one's a little more complicated, let's break this one down too. You're predicting what another group is going to be doing and anticipating that decision-making process. And we never can be sure what information the Fed is going to use to make its decision. Even if you did, and this is key guys, listen up, even if you did know, you would never know how that information is going to be interpreted. So you can't just say 50-50 like you might be thinking. And why? Because there's obviously more than two possible outcomes. You don't know how that information will be interpreted. So most economists will throw out a number like 60-40. And many people actually believe that number, which is even more sad. So how do you assign 60 probability to a number that can't, or probability that can't even be measured? We're going to get there further on in the presentation, but let's move on to our last situation, and you'll kind of see where things are going. Say you're an artist, and for a long time you have painted in a super realist style. Okay, however, you have also longed and admired spare lines of Japanese art. Okay, so you would like to integrate the two styles, but you don't really know how. You only know how to develop a style is to continue painting and experimenting, but you know that if you work at it long enough, you might be able to come up with a style that you feel fit you best. However, you haven't have a clue about how to turn out or whether you will be a successful trader. You look ahead maybe 5-10 years, and you're trying concepts that don't work, that only partially work. So do you follow that path? So uncertainty situation number 4, if we break that one down, if you follow this path, your family might ask you questions like, what do you think your chances are? And you might say something stupid like 70%. And I say it's stupid because the less information that you have from the problem, like, does that just mean that you're guessing, or does it mean that you're actually knowing what you're talking about? So just to sum these, these situations up, dilemma 3 and 4 are too complex to assign any sort of probability, okay? We repeatedly throw dice in example number 1 to figure out that answer, and example number 2, we just repeat trials. So example number 3 and 4 can't be repeated under the exact conditions all the time because we do not know what the current conditions are. Just like we don't know what the current conditions are in the markets. So you can't play everything exactly the same way because you don't know what those current conditions are. You have true uncertainty. So guess a number between 1 and 100. Okay, go ahead. Think of one. There's 3 different strategies that you can apply here. Okay, you could say, I don't know what everyone else is going to do, right, who's watching, obviously, this presentation. But it's probably random, so if you were to guess a number between 1 and 100, trying to get, obviously, to the closest to the number I'm thinking of, you might guess something like 50, splitting your odds in half. But there's a second group of people that will probably say everyone's going to guess 50, so I'll guess 25 and bring the average down. Then there's a third group of people that will think, you know, this group looks smart, they'll probably guess 25, so I'll guess 12. So let's take this experiment a little further. Let's pick a number between 1 and 100 again. So think of that number. Now, some of you will realize how this works, okay? And that 3 becomes the next number that you're going to guess. Because if you think about it, if you keep on dividing the numbers like what we did in our previous example, 3 would then be half of the number that we already thought, which was 12, and we divide that in half and half again, and we get 3. So how do we increase our returns based on all this information of uncertainty and using, I guess, uncertainty, now that we know that the more information we have, it doesn't necessarily help us? I'll try and make this short, but say we're trying to play a simple game of poker, okay, between us and the dealer. Okay, so first we might bet $1, and then the dealer takes out all the 7s out of the pack and shuffles the rest. Okay, so if we pick a number higher than 7, we win. Lower, we lose. Okay, so we have about a 50% chance of winning. There's 24 cards greater than 7, and obviously 24 less, giving us those 50-50 odds. Upon getting our cards, we look and we think we can either fold and lose our $1, right? We can call, or 3, you can call and ante up with another $1. So if you decide to ante up the $1, the dealer can either fold or call and then bet $2. Okay. If you don't know poker, don't worry. You know, the example will prove itself. But there's a card greater than 7, we win. So we can take on one of 4 strategies. We can either always fold, which seems kind of dumb. We can always up the ante, which doesn't seem that right. Or we can 3, up the ante on a good card, or 4, fold on a bad card, right? Or fold on a good card and ante up on the bad card. So we can take up one of these 4 strategies. We can always fold. We can always, raise up the ante, which doesn't seem so bright. We can up the ante on a good card and fold on a bad, or fold on a good card and up the ante on a bad card. So strategy 4, the last one here, seems to hold some promise, but strategy 3 seems to be the most sensible, right? And 3 obviously being up the ante on a good card and fold on a bad card. So the dealer then catches on and sees what you're doing, and that you're folding every time on a bad card. Well, what happens now is the dealer can either predict what your next move is. Okay, and when you become predictable, you can be played and your return is 0. Okay, you won't make anything. However, if you combine strategies 3 and 4, and 1/3 of the time you switch strategies, then you're not predictable anymore, right? And your gains actually go up to 35 cents for every hand you play. And then all you have to do is increase the amount of hands you play and you will make lots of money. Okay, and that's in our simple game of poker. Same thing applies to the Forex, okay, and the way we play harmonics. And that's what's important, the important details to take out of this lesson. So what does this all mean, and what did you learn today, or what should you have learned today? And you should have realized that a profitable system can't work all the time because of uncertainty. But this is why the majority of the traders fail, because they give up when the market isn't working for them. They can't work all the time. And it's that uncertainty that actually makes us successful. Okay, so you realize that you have to keep going no matter what you try to do to gain probability in the market, even if you lose. And betting when you have a bad hand is also important. Okay, what is a bad hand in the Forex? Well, let's look into that in our next video. Okay, guys, have a good one, and we will see you soon.